Hello and welcome to Wall Street Wire News, where you can get today's markets in minutes. Hi, I'm Dave Okenquist. Joining me today is Rodney Johnson, special contributor to Wall Street Wire, former Wall Street bond trader. Rodney, good morning.
Morning, Dave.
And also joining us is Charles Sizemore, the editor of the Sizemore Income Letter. Charles, how are you today? And where are you coming from in that beautiful location?
I am from a very random small beach town called Playa del Sol on the Peruvian coast. Don't ask me why I'm here. We don't have time. It's a long story, but you know what? The Pacific Ocean's back there, so it's not too bad.
Yeah, it looks absolutely beautiful. And you're coming in clear and we can hear you well, so that's great. I'm very jealous at the moment here. I'm stuck in the barn. But guys, last week, we weren't here last week, but the week before, I posed the question, the rise of Robinhood traders. And we were a little bit trying to figure out what was going on. And wow, in our time gone, we had an absolute explosion, of course, led by Wall Street Bets on Reddit and people buying up Gamestop like nobody's business. I don't want to rehash all of that. Of course, Gamestop shot to the moon, and I think it's slingshot and is now burning on re-entry. But Rodney, I think more than that, we can certainly talk about some of the mechanics around that. But I think the real worry for most investors, unless they were in there buying GameStop on Robinhood, was that if these hedge funds get in big trouble and they're undercapitalized, that this could actually be a trigger event for the wider market. What do you think?
It's possible. It's not very likely. I mean, the argument is that, you have like Melvin Capital, that's one of their business models, is to short stocks that they think the prices are too high and they're going to go down. But it leaves them open to an infinite loss. That's the thing, right? And so you put some money down, but as the stock goes against you, in case of GameStop, it goes up, you have to post more capital to cover that potential loss. They haven't sold it yet, but you have to keep posting more capital. It's a margin call, the old margin call. And so the question is, where do they get the money to post? And so it's not like they have a bunch of cash sitting around. I mean, they have other investments. And so how this would potentially affect the market is they have to sell other investments to make good on this margin call, which could lead to downward pressure on other things that they own. And so it's so small in terms of what goes on in the overall markets that it's not a big deal, but it could cause a temporary blip of other things if you saw a lot of money running out of, say, Google or some other stock, because they all trade at the margin. The last share of Apple to trade is the one that prices every share of Apple in the marketplace. And so it could cause a blip for a small period of time, but it does work itself out. And as we've seen with GameStop, guess what? It goes up to over $500 overnight a few days ago. Last I saw, it was under 60 and headed south. And so, frankly, the hedge funds are going to make some money, and they make money on other things involved in this anyway. And so while everybody wants to take the hedge funds, out behind the barn and beat the snot out of them, they're still making cash.
Charles, your thoughts on all this craziness, and do you disagree with Rodney at all that events like this, if they happen in the future, could become a risk to the broader market?
Well, first off, I believe the metaphor is take them out behind the barn and shoot them. It's not take them out by that. If we're going to be, doing correct metaphors here. So go way back in time. Think back to 1998. That was when long-term capital management blew up. Now, that was a precursor of what could have had, what happened in 2008 when the financial system blew up. That really could have happened in 1998 had things gone a little bit differently. Long-term capital management was a huge hedge fund that did business with basically every bank on Wall Street, and they got into trouble. They borrowed too much money in investments that proved to be illiquid, and they started getting margin calls. Well, what happens is when they owe money to every bank in town, everyone wants their money at the same time. Alan Greenspan, the Fed chairman at the time, actually had to have a smoky bat. Well, I say smoky. I don't know that there was actual smoke, but in this telling of the story, it's better if there's cigar smoke lingering in the air. But a smoky backroom meeting where he had all of the heads of the banks, and he said, "Look, guys, you're either all going to be in this together, or you're all going to blow up together." And they got together and basically bailed out long-term capital management. Now, what happened in GameStop was not that. It was too small to have been something like that. Long-term capital management was a massive hedge fund. That would be like something like Citadel blowing up today. That was not the case for Melvin Capital, for example. relatively small fund. I think the fear was that you could have some version of what happened back in 1998 happen again, and that is a risk going forward. That's always a risk that some massive player in the market blows up and takes everybody down with them. Now, you like to think the regulators have gotten a little bit smarter over the years, and they have some protection against this happening again, but I don't know. I don't know that they do, honestly. You did see some crazy trading action around Gamestop, where several brokers stopped allowing new trades in it, and that, of course, created all sorts of theories as to why they were doing that. But one of the explanation they gave was that the brokers themselves didn't have enough credit to keep trading the shares. Like, the brokers themselves were affected. It wasn't strictly speaking a margin call, but the brokers themselves were coming up on capital constraints in their ability to actually allow their customers to trade the stocks. So while it didn't go badly, it could have. If things had been a little bit different, this could have gone very differently.
Rodney, there was a lot of anger there when Robinhood halted trading shares, and even we saw a very, very brief moment of unity between the left and the right. I believe it was Alexandria Ocasio-Cortez and Ted Cruz actually agreeing on one thing. But I mean, are we in a new era here where there was calls of market manipulation, which seems ironic coming from hedge fund billionaires? But could we be in a new era where I don't know if you want to call it it's basically a bunch of little guys really going after the big fish? Could this be a new thing, or has this been successfully crushed?
I don't think it's been crushed. New era, it's still social media. The focal point of many people getting together easily to concert their efforts. That's what this is. And whether it's politics or Wall Street, doesn't matter. It's all social media. And I'm one of the people that think this is clear market manipulation. Charles mentioned that the brokerage firms like Robinhood and TD Ameritrade and others said, hey, we're running up against our own capital constraints. We can't put through these trades. That doesn't hold water on fully long positions. And so if I want to fully pay for a share of stock, or I want to fully purchase a call or a put, then there is no capital constraint, because I, as the individual investor, have put up the money. It exists. And so when they said, look, you can't buy more than X number of shares fully paid for, they were doing nothing more than throttling trading from individual investors. Now, they might have had wonderful motivation saying, hey, this can't last. We don't want you to lose your money, whatever. That's not their job. That is absolutely not their job. And so what they did is give a gift to the hedge funds by not allowing it to flow where individuals wanted to go. And so I am of the mind that what Robinhood said when they started, let the people trade, is what should have happened. And as long as people are fully informed and it's their money they're putting at risk, let them do what they want to do. There was no manipulation here in the sense of somebody doing something in the cover of darkness and saying, hey, it's the old pump and dump where let's get together, not tell everybody what we're doing, tell everybody, some phantom story about how it's a great stock. And when it gets to a nice high level, let's all sell it before everybody else. That's not what this was. People just out in the open said, hey, let's go do this. And
it was transparent. It was out in the open. Yeah.
You may not like it, but there's nothing wrong with it.
Charles, what did you make of that?
I agree, by the way. I actually do think there probably was some dirty business with the brokerage houses. I'll be really interested to see if Congress actually follows up and investigates this. I'll be very interested to see what comes out, because I agree with you. The explanation I got from the brokerage houses did not really seem to hold water.
Absolutely not.
Good.
And we'll see regulation. And my prediction is we will see individuals regulated through the Federal Reserve or the Treasury. This is going to be something where they say, for your own good, we're going to stop you from doing such things. And it will be just as offensive as every other thing they do for our own good.
What about hedge fund billionaires going on CNBC and calling all these traders losers and people living in their mom's basement and complaining about all the stuff they were doing? Charles, what do you make of that? Any sympathy there?
Well, some of them very well may be. Who knows? It's not. That doesn't matter. You could be the world's biggest loser living in your mom's basement and still have a fantastic trade thesis. It doesn't mean that you didn't make a great trade. And where I kind of go down a different rabbit hole here is these hedge fund guys are professionals. Like, they are supposed to know better. And I don't know who was piling into a short when you already have 140% of the shares available to trade sold short. Anybody with 5 minutes of market experience should know that that was a highly risky trade. The potential for a squeeze was there, particularly if you have millions or tens of millions or more in the trade. You should know better than that. This was, I think, the most embarrassing aspect of all of this is that the hedge funds that were short, it doesn't matter if they had all the right reasons. If GameStop is going out of business tomorrow, I don't know, maybe they are. I haven't been to one. I mean, I have kids that play video games, and even I haven't been to a GameStop in a long time. But they, anybody with any trading experience should know you don't you don't take a huge position that you can't get out of in a one-sided trade where the potential for being wrong on that is massive losses. Now, this was an epic short squeeze. Most of them aren't this big, but all the same, good night. What were these guys thinking? These guys are pros. They're supposed to know better.
Yep, and the Redditors found they found it, exposed it, banded together, and
right. But that becomes the self-regulating piece, which is GameStop and Reddit Wall Street Bets are now part of our history. And so, to Charles's point, when you're doing the math on this, and you say, well, okay, I'm gonna sell short GameStop, and I'm gonna sell short, I don't know, 1 million shares, right? And so I'm going to estimate my potential loss. And maybe my potential loss is 2 sigma, right? A couple of standard deviations. My loss is X. That's pretty tolerable. Maybe it's even 3 standard deviations. Nobody plans for that 7, 8, 9 standard deviation move because historically they did not happen. But now they have. And now that they have, that exact measure that Charles was talking about, the percentage of shares sold short, before you sell short yourself, is going to take on utmost importance as people say, look, if there's already 40, 50% short, I'm not piling into this trade because I don't think I can get through the door on the way out. And so I think this becomes self-regulating, and that people are going to take that in effect. And it's going to be much harder to do a GameStop thing starting in April or May once the curve roll off.
Rodney, you're an experienced trader. Would you have entered a short position? You personally, not saying you're running millions for a hedge fund, just your personal account, would you have piled into a short where 140% of the flow was already short? I mean, I think I know the answer to the question, but I have to,
And so actually, I do follow a couple of trading strategies that go the other direction. When I see that high amount of short, I go buy long, thinking one day there's going to be a short squeeze and I can make money.
Of course.
But that's not the problem with GameStop. I can't imagine there are many hedge fund or professional investors who said, hey, look, let's pile into GameStop when it's already 40, 50, 80, 90% short. I think what happened, and I'd have to look, is they went short and then other people went short as well. And they didn't pay attention to the rising percentage of short when they were already in it. And they should have been scaling out as other people were scaling in. That's what they didn't do, is they didn't keep track of their
They weren't paying attention, but that's their job.
Exactly.
It's their job to pay attention.
And they will pay much closer attention in the future.
Yeah, for sure.
I want to hit on some news quickly that came out today. The U.S. economy added 49,000 payrolls as the S&P is heading to all-time highs. Charles, is that not a great? Doesn't that aptly show the relationship between the real economy and the financial markets?
Yeah, I don't think I really need to expound on that. I think you pretty well covered it. It's funny. The economy has recovered by leaps and bounds from the pits of the early months of the pandemic, but we've basically recovered to the point where we're at the bottom of the 2008 meltdown in terms of like unemployment. Well, roughly, right? In terms of just damage to the economy and lost output and whatnot. After the massive improvements in the economy over the last several months, we've basically clawed our way back to the trough in 2008. So that shows you how much further we have to go. And there is definitely a disconnect between Wall Street and Main Street on this.
Rodney?
Well, I think the disconnect is bridged by an awful lot of cash coming out of Washington. And so the modest jobs number was expected. Everybody thought it was coming. But as we all know, we're looking at the Biden administration pushing through a $1.9 trillion relief package which is going to put more money in people's hands. And that adds to the CARES package from last year of a couple of trillion. And then the one in between, and I don't even know what the name of that was, with another 900 billion. And so what you're talking about is $4 trillion going out to individual spenders, not counting the $3 trillion the Federal Reserve has printed and the 120 billion they're printing every month. And so Wall Street is making a very calculated bet that an awful lot of money is about to flow into the economy in a huge way as the lockdowns come off. And it makes sense, right? Everybody we know has cash and is going to go spend it. I don't want to be unemployed. I don't know anybody who wants to be unemployed, but guess what? Most people aren't. 6.3% unemployment means, 93.7 employed. And those people who are unemployed, they're getting the federal bonus. Now, it's a little less, it's half of what it was last year, and it's about to go up, but it still means that about 50% of people who are unemployed make more by staying at home than going to work. And so, boy, there's an awful lot of cash we're throwing around right now.
Yeah, and depending on what comes up in the next round of stimulus, that may be even more, Rodney, to your point. I believe the proposal is an extra $400 a week for unemployed federal assistance.
Well, it's changing it from 300 to 400 when the current one rolls out or ends in March. But I'll tell you, a bigger deal is the federal student loan forgiveness is coming back, and it's going to happen. Apparently, the question is, at what level do we give everybody with a student loan 10 grand, or not give, but forgive 10 grand or 50 grand? And I think of every doctor, every lawyer, every, person on Wall Street, every hedge fund lackey out there who's been in the business for 2 years, they likely have student loans, and you're about to hand all of them cash. It's offensive. It should be offensive to every taxpayer, but that's what we're about to do. And guess what? It pushes spending.
I paid off my student my student expenses.
Yep. I paid off mine, and I paid for my kids to go to college. And so they didn't take student loans. I don't, nobody's going to have sympathy for us. I get it. I'm not asking for it. Only 35% of Americans get a college degree. What do you tell the people who never took on a loan? They never went to college. They're doing their job. They're making decent money. They're paying their taxes. What do you tell them when you're going to give some of their taxes to people who took student loans? I just don't know how you look.
It's a regressive tax. It actually is a regressive tax.
Absolutely. Absolutely.
Well, you just give them all 10,000 too, and then we're even. All right. I want to hit on some tech news in the auto industry. Apple is partnering with Hyundai to develop a self-driving car, and as well as Google is partnering with Ford to integrate into all their electronics. We've talked electric vehicles, but this is a leap forward. Self-driving cars. Rodney, how far off are we from that?
We're a really long way from that. It all comes down to liability, and nobody's explained how that's going to work yet. When you have an autonomously driving vehicle kill someone, who pays?
Which has happened.
That's right. The Waymo car in Phoenix, Arizona. And so this is, and that woman that was hit was in the street, not at a crosswalk, blah, 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 blah. What happens when a car runs over somebody in a crosswalk or something else like that? I do not know how that's going to resolve. And until we get the liability resolved, I just don't know what insurance company is going to take that on in any big number. I mean, Google is big enough to self-insure against, their pilot fleet, but I don't think Geico is willing to take this on for the millions and millions of people, or USAA. And so until we figure that out, you can do all of the techno advance you want.
I think it's gonna require legislation.
Yeah,
because you go to a ski resort in Colorado, you think like skiing is dangerous. Like skiing is a dangerous sport. I mean, I've hurt myself. People blow out their knees. People get concussions. It's dangerous. But you can't really sue Vail Resorts if you blow out a knee skiing. It is part of the law. I believe. I may be misspeaking, but I believe it's it's enshrined in statute in Colorado that you can't sue the resort if when you ski, you're assuming that there's risk involved. So I think you would really need something similar with the self-driving cars. And does that happen at the state level? Does it happen in Washington? I have no idea, but I think in order for it to really happen, really become viable, you have to have that. Otherwise, the lawsuit risk is just catastrophic.
Yeah, and I chuckled, Rodney, earlier, not at the death of someone, but just the idea of most of the stuff I've seen out there wants to put the liability on the person who's in the vehicle, and I just see no way. I would not. No, there's no way in hell I would ever get behind the wheel of an autonomous vehicle. I'm going to sign a waiver that if this thing goes and destroys everything, that I'm personally liable? There is no way.
So that's actually a good point. And so to clean up Charles's metaphor there, or simile, when you ski, you sign a contract that says if you get hurt, you don't hold the hill responsible. The bigger issue is if somebody else on the hill hits you. You can't sue the hill, but you can sue them all day long for being reckless in their behavior on the hill. And so that's what we're talking about here with cars. So killing a person is what I use because, of course, it's graphic and immediate. You can see it. The much more likely scenario is you've got it on autopilot and you hit something. You hit another car. You hit a curb. You do property damage. That's the really likely thing. And then your insurer is going to say, "Hey, wait a second. You were behind the wheel. You caused that $20,000 worth of damage to that other vehicle or whatever." And so that is the huge thing where individuals cannot take that monetary liability. They just don't have the ability to do it. And I don't think insurance companies are ready to insure against that.
The other thing at Ford, that was a $29 billion through 2025 for both electric vehicles and autonomous vehicles. But as we have thoroughly discussed, autonomous vehicles are a long way off, but electric vehicles are not. Now, another interesting thing here in the story that I saw on CNBC is that Ford is pausing its production of its F-150s. Why? Because of semiconductor shortages. And I just want to pose this for all of you. And really the question is, could we be seeing potentially a commodity boom? If you look at the materials that go into semiconductors, aluminum, gold, silver, lots of metals, copper, boron, lead. I mean, there's a whole list of them, and of course, silicon. But that's the question for you all: is this semiconductor shortage real, and could that mean a rise in prices in the materials required to make them? Charles, you first.
Well, there's no shortage of sand, so that's I'm joking. That's the broader question of do we think that there could be a commodity boom on the rise? And I actually think so. It's been a while since the last one, and not to make this just ridiculously simplistic, but commodities go through boom and bust cycles, and it's been a while since we've had a boom, and consequently it's been a while since there's been a lot of new investment. Now, part of that was when China started to back off of its big infrastructure spending, that reduced demand for commodities. It made it less urgent to bring new supply online. But what's the best way to get the economy around the global economy just back on track after the whole coronavirus experience? Public works, infrastructure, road building, bridge building, whatever, just throwing money at construction projects. I think it actually is really likely that commodities do enjoy a nice boom over the next several years. It's the timing is commodities are tough. I always thought the best way to do commodities is to just have it be sort of a semi-permanent part of your portfolio that you just kind of have part of the mix. You can expand or contract the size of the allocation, but you just kind of always have a little bit of commodity exposure, and let it run. And I think that's actually likely in the years ahead.
Ronnie, can we be seeing a commodity boom? And if so, how can investors take advantage of that?
Yes, we are. It's coming. And so, as Charles said, best way to get your economy going is to do really big infrastructure projects. We're going to see one here in the U.S. It's going to be $1 trillion. It's going to rebuild roads and bridges and stuff. We fight about it. Other countries don't fight about it. They just go do it. And so you're going to see a lot of demand for commodities ramping back up. You're going to see the softs ramp back up with the different crops. That's going on now. The Chinese are buying what they said they were going to buy during the trade agreement with Trump last year. And so this is coming. Is it driven by semiconductors? Man, that's a manufacturing bottleneck that'll, work itself out because we had a huge demand for laptops and different things during the coronavirus, not just here, but around the world. That'll ease. but the commodity boom will not, because as Charles said, we were in a down cycle for years, and now we're in an up cycle. As to how you play it, like he said, it's really hard. Funds are the best because you can just buy it, set it, and forget it. There are people that trade commodities. I'm not one of them because it involves being really close to it. Energy is part of commodities. I think energy's on a rebound from the low. And for something Charles said, lack of investment. I mean, you're seeing all these large energy companies say, we're not going to put money towards new exploration and production anymore. Well, guess what? We're going to use oil for a long time. And so if you're not putting money into finding more and getting it out of the ground, you're going to cause a bottleneck. And so that's one of the ones that's going to do better.
Absolutely. Guys, I want to thank you, gentlemen, for joining me this week. I want all of you to head on over to wallstreetwirenews.com and sign up for our free e-letter where you can get today's market in minutes. Rodney, as we look ahead to the week, what should investors have their eye on the news to come before we regroup next Friday?
Well, I mean, it's going to be the stimulus and the reaction to the stimulus and what people expect out of that. We just got some big earnings from the large tech companies with, Google and others reporting. And so with that behind us, I think we get into a little bit of a glide path here where people can expect it to be less volatile than it was. And so I think it's going to be all about things coming out of Washington for the next week or so.
Charles, your thoughts, and how can everybody find your work if they want to check that out?
Sure. Yeah, the week ahead, I think the overall bullish narrative probably continues for a bit. That's just the market we're in. There will be setbacks, but I feel like we are in those late stages of a bull market where that narrative is just really bullish, and I expect that to continue for a bit. As for where to find me, Sizemore Income Letter is my newsletter. You can find me at charlessizemore.com.
Great. For Rodney Johnson and Charles Sizemore, I'm Dave Okenquist, and have a great trading day.